Major support for these broadcasts is provided by the CUNY TV Foundation, New York Community Bank, Kilroy Architectural Windows, New York's window company, Capital One Bank, Perfect Building Maintenance, Chase Commercial Term Lending, Geneva Burns, Giantomasi and Webster, M&T Bank, the Wyckoff Group, Chelsea Lighting, Greenberg Traurig, LLP. Additional support is provided by Ackman Ziff Real Estate, AKA Hotels, Corman Communities, Bank of America, Merrill Lynch, Bank Leumi, USA, Briarwood Organization, CBRE, Colliers International, NYC, Cushman & Wakefield, DDG, Douglaston Development, Levine Builders, Dime Savings Bank of Williamsburg, Eastern Union Funding, Flushing Bank, Friedman LLP, Herrick Feinstein LLP, Hersha Hospitality Trust, Investors Bank, New Banks, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katsimatidis, Red Apple Group, Margolin Weiner and Evans, Madison Realty Capital, Meridian Capital Group, Newmark Grubb Knight Frank, Popular Community Bank, SJP Properties, Sterling & Sterling, Stonehenge Partners, Urban American, and these friends.
Apartments renting for $100 a foot. Condominiums being sold for $4,000, $5,000 a foot. Real estate is hot. We're in 2013, but many people believe we're like back in 2007 when real estate was selling, everything was there, young developers. You know, this was a time that people were exuberant, or one would say irrational exuberant. Now, I'm not Peter Lindsman, who's written some books about this, but I am a little pessimistic at times, and I believe people have to look at what's going on with the European debt crisis, the Middle East, North Korea, and just business in general. So as opposed to my pessimistic idea on what 2013 is, I brought together some friends to provide their insight on how they look at 2013 as compared to 2007. My guests today include Gino Martocci, who is Metro Regional Executive for M&T Bank, Thomas Lydon, who is the President of City Investment Fund, Mitch Rutter, who is the President and CEO of Essex Capital Partners, and last but never least, my dear friend Jim Orphanides, who is the President and partner at Centurion Holdings. It's always good to have my pessimistic friend next to me, sitting on the left side. So
my whole life I'm an optimist. Now I'm a pessimist.
Yeah, okay. You know, you've been on many times, and you know, people sometimes say you're a little, not as bad as me. Okay, how do you look at 2013? And do you think people are becoming irrational? Do you think things are going on?
Well, if you're trying to focus on the real estate industry, which is obviously...
This today is real estate, even though we're a business report.
Okay, but the real estate industry, especially in New York and some other metropolitan areas, you can't say that there's been huge suffering, because during this recession, it doesn't seem like there has been the same disasters where you see foreclosures everywhere and hundreds of condominiums being foreclosed. So New York City is kind of the anomaly in terms of the residential world as well as the commercial world. And I will take out industrial because we really don't have a lot of that left.
We're talking about, I really want to talk about the residential, the office, the retail, you know, what we're in the metro region. Well, you know, Tom also lives in Hoboken, you know, that market over here. And, you know, things are happening. You know, Mitch has developments, one of the larger West Side developments. He owns a major building, and he's also in Brooklyn and in Maryland and other places. But, you know, and Gino is responsible for the banking, you know, in many states in this region. Are we on a potential bubble? I mean, are there problems over there? What do you see?
Well, look, if you compare it to 2006 or 2007, the underwriting is substantially different today than it was back then. They're not doing pro forma underwriting. And quite honestly, I think everybody benefits from the sort of reliquification of the market, right? The fact that capital providers are back at a faster pace than we would have thought is a good thing. The question is, and it seems to be an open question at this point, is whether the banks and the capital providers learned anything from the crisis previously. And there's increasing evidence that there's a bit of a collective amnesia going on. And there are a few differences from 2007. Residential rents are higher than they were in 2007. And if anybody back then had underwritten $6,000 a square foot for a condominium sale, they would have thrown them out of their office. And that's what's being achieved on 57th Street.
But in 2007, people were pro-forming office rents at $150 to $200 a square foot. And today, with the exception, with the exception of Midtown South, the office market is weak in New York City today.
Midtown is weak.
Right, and we have Lower Manhattan. We're going to have a substantial amount of new space being built in the Trade Center site, and then you have the Hudson Yards. And besides the Hudson Yards, you have Joe Morney and you have Extel, you have others. You know, you're the developer amongst us. Okay, how do you look at this?
I would say that the banks that we deal with, one of which is M&T, have not thrown their standards out the window. I will tell you, as a consumer of construction loans, some of the smaller banks entering the market are more willing to develop new relationships by limiting the recourse requirements on some of the new construction loans. And certainly that's allowing newer faces to enter markets and take risk.
And this is exactly what I'm saying. There are a number of banks and there are new players coming into town that we all know. Banks from Florida, banks from Pennsylvania, parts of New Jersey, upstate, who are coming here, and they are reducing the amount of money that somebody needs, and they're not looking at the experience that you require when you do a loan. And what happens is, you know, construction is a 2-year process. You know,
longer.
Minimum of 2 years. And you know, so when you start a project today, we're hoping that in 2 to 3 years, it's going to be good on the rental. And we don't know that market. You know, that's the risk effort that a banker does.
Well, you know, look, a lot of banks were out completely. M&T was lending in 2009 and 2010. A lot of banks were out completely. To the extent that they come back, they've got to bring something compelling back with them to be considered relevant. And so, unfortunately, what you're seeing is you've got a few banks, whether they're new entrants or guys who came back after a 4-year hiatus in some case, and they are lowering some standards. That said, the amount of equity in the deals today is still better than it was in 2005, 6, and 7.
I would say that is definitely true, even from the banks that are re-entering the market. The other thing to keep in mind, which is certainly fueling what I view as what's making it very difficult to be an active buyer, is the rates are lower today than they were in 2007. So what you have is, in my mind, the capital availability, both debt and equity, overwhelming the fundamentals of a transaction. So right now in New York, any class office building, A, B, or C, is viewed as a core asset. So you have a core asset in a gateway city, and there's many capital providers from offshore that are very, very happy to buy it at a 4 cap.
You can get positive leverage at a 4 cap.
Right.
Mm-hmm. So
but that's driven us to look and still try to uncover the hairy deals.
Tom, how many residential units do you own?
6,000 units, 4,000 in Manhattan, and 2,000 in the boroughs. But I think, from my perspective, I'm not pessimistic, but I think it's time to be very cautious if you're on the buy side, okay? And the banking side, since I've been through 4 or 5 downturns,
And
the answer is the real estate industry does not learn its lesson, and people will lose in underwriting, and competition will drive you there. You just hope it doesn't get to the point.
It's like the stock market. Everybody thinks the market's going to go up. Investment clubs are back. People are believing that, you know, we're going to see 15,000 for the Dow or higher.
Well, you do have senior executives in most of the financial institutions who now have been through at least one or two cycles, and I'm hoping, you know, that affects
you know what?
that affects
you
their
and
behavior.
Jim and I have seen more than one or two cycles.
That's right.
Okay, and you've seen it as an executive of insurance companies, and you've seen it that some of these insurance companies have gone out of business. Okay, how do you protect and how do you mitigate?
Was the reason for
potential
them
risk?
going out of business the economy, Michael? Was it because of pricing, Michael, or was it because they were failing in their fundamentals themselves?
I'm just asking. you.
Well, the ones I've worked with, it was failure in investments, primarily real estate. But it's very hard in a financial institution, like a bank. And do you know how much origination did you do last year in real estate?
In New York City and Westchester, 2.8 billion.
Okay, 2.8 billion. Well, everyone's natural tendency is Gino goes to the bosses and they say, it's pretty good out there. Let's increase that to 3.5 billion. And it's very hard to just say, hey, there's caution coming. Let's reduce our budget next year in advance of problems occurring down to 2 billion because Gino says, hey, there's too much risk out there. That's a very hard thing to do when you're charged with growing the bank or growing a portfolio or growing real estate and institutional sets.
I will say this: just because your neighbor jumps off a bridge doesn't mean you should. And
you shouldn't.
And the fact is, you know, the banks that do this over long periods of time do pull back, at least certainly on the margin. And
well, that's going to really tell the tale. But the fact is, caution is necessary. Margins are, you know, you could have bought land, the best land, for $200 an FAR foot for any type of property 4 years ago, if you had cash, and very few people had cash. Now you're up to $400, $500, $600 an FAR foot.
Land.
So
I mean,
the
Mitch,
margin.
Mitch knows Brooklyn. He's seeing different parts of Brooklyn today. Brooklyn, in certain parts in Bronx, you were able to buy in 2008, 2009, maybe for $80 a foot. No bank would finance a loan.
There are sites in prime Williamsburg that are edging up to 300 a foot.
Well, that's what I say. The answer is rents go up. They don't always go up every year. We've bounced back from a recession, rents pop up, and then everybody starts using that pro forma at the higher number to go higher and justifies a higher land price. So your margin goes down, and your risk increases from the equity.
A friend of mine, Bobby Toll, would be if he were sitting here saying, show me the property I can take in Brooklyn and I'll build a nice apartment building.
He'd build a nice condominium.
A condominium.
He wouldn't build an apartment building.
Or a condominium, whatever.
Because his mantra is to sell condominiums, to get rid of the deal and not live with them for a long time.
But the real question would be, if you had it to do all over again, would you be in New York City a lot sooner? And he probably would say yes. Absolutely yes. So, but walk through the economy. There's so many good things happening. Wall Street, yes, is a major indicator because it usually is in front of the economy. Real estate is behind that indicator. It takes a long time for real estate to catch up to Wall Street.
But I believe one of you said to me in the green room, you know, Wall Street has reduced the number of employees. They've cut down on bonuses. You know, so
maybe they're practicing business fundamentals. They don't need the extra help. They don't need to spend the extra money. Why not make some profits? Why not?
I'm sorry.
Go ahead, Mitch.
No, I think what you're seeing is New York evolving, losing some of its reliance on the finance industry, taking advantage of what was quantitative easing to become an idea economy. But I will say that we're cautiously optimistic, but there are two variables that we haven't discussed yet that certainly affect our outlook and how we underwrite what we look at to buy. One is the next mayoral election. We're very, very concerned about that, very concerned. And the other, which really ties in, is the rate at which real estate taxes could rise. You know, we're now concentrating on building a lot of multifamily along the subway lines. You know, we're able to generate high returns, and there's less foreigners chasing that. Now, if taxes go up at huge rates, what's that going to do to the net?
Well, you're looking at 28, 30% of revenue now.
And you see it coming
on a new
because the
new
city
product.
now has moved up its informational filings by a few months. And this is the first year where if you don't file on time, they're going to impose large penalties. So you could see where it's going.
Well,
Well,
that,
just
and
increase
that
the tax.
impacts under, as I say, if you
Right.
pay $400 a foot and then the taxes go up 25%
Sure.
while you're building it, all of a sudden your margin shrinks and that's when you get into issue. Even though there's strong demand, even though you can lease the apartments or sell the apartments, the risk is too great and all it takes is a slight correction, a drop of 10, 15% in condo prices. Not everybody can pay, $2,000 a foot, okay?
You know, I do a show a couple of weeks ago in Long Island City, and they say to me, $1,100 a foot, we're a bargain. You know, rents, of $40 in Roosevelt Island, $52 in Long Island City, were a bargain. My question, and I've said this numerous times, is, we have a working force people. We don't have enough housing for them as it is. Okay.
That's fair. That's fair.
Okay.
That's fair.
Where did these people? Where can they afford to live?
They live where they drive to where they can afford. The same old rule that we all had for the last 30 to 40 years. You drive to where you can afford, and many of them live in the suburbs. Some of them are even in rural areas. I know people in Bethlehem, Pennsylvania, that commute daily to New York City. How's that sound?
I will give
4
you
commuter
better.
buses were added recently in the last
The
month.
person who takes care of our, wonderful makeup over here moved from Long Island City about a year ago, and I was talking to her before, and she bought a home in Pennsylvania in the Poconos, and
Takes the bus, right?
she takes the bus, and
And
she loves
the American dream
quality.
has been fulfilled.
That's right, and at a price that you could not even, we couldn't go to Bed-Stuy or into Brownsville to see this type of opportunity.
But what drives the economy, Michael? Go back to fundamentals. Consumption. And people are consuming. Look at the car statistics that just came out in March. Wasn't that hitting the cover off the ball? Yeah. Let's face it, without that optimism, we can sit here and be cautious and we can talk about that, but let the people are expressing a kind of optimism in spite of inflation, in spite of the fact they haven't had raises. Of course you have to consider the world.
You don't look at the global effects on
Always. You look at every one of those fundamentals.
And wait a second, isn't there still a large number of people who are unemployed? Okay, there's a shadow unemployment over here,
Of course there is.
Well,
But
one can make the
moving-
case that the problem of North Korea or the Mideast is what's driving a lot of these foreign buyers to buy things for $5 and $10 million. So
safest country in the world,
there
the
you go.
United
And
States of America.
so again, when you're talking about
But are
supplying,
we talking about a world that we only have wealthy people? What about you can't run a business, the studio, the restaurants. You need people. These people have to have homes. They have to be able to afford food.
they go. If you commute 2 hours a day, that means you don't make as much money. And then you get a little more successful, you move closer to town. So, that, I don't, look at the uproar that is now in the papers politically when HPD, I don't know if it's HPD, is trying to build on the FAR around the NYCHA projects, okay, and use that as a way to provide money for the upkeep of all these New York City projects, which is absolutely necessary to take the burden off the city directly, but it becomes a political nightmare trying to, even if it's moderate income or 50% moderate income, it becomes a very difficult thing to do.
Here's the question, and Gino, you see this more often, and Mitch sees it because he's competing with the situation. There are some young guys who got into this business like at the beginning of 2010, and they bought buildings from owners, and the world changed. And then there are certain people, because there are foreign investors and other investors who are buying these buildings at a higher prices, and they believe that they are the new masters of the universe. And because the fact that interest rates from the bank, even though the spreads are maybe better, they're able to buy a property and they have a good leverage on the situation, the spread over there, and they believe that they can go in and now, hey, I made it in rental housing, and now I'm going to be a condo developer, okay? And I'm going to find a little site, in Bushwick or in, Auburn or something like that.
But those people, Michael, were always there during the good times. When money is available, real estate developers are going to build, no matter if.
So I will just tell you this, and I'll be careful in how I explain it. But we lost a bid on a prime site in Williamsburg on the water, or a block off the water with water views. It was a square block, and somebody came in, went to contract without adequate environmental studies, to my mind, and without possession. And I will tell you that we wound up participating in the hard money loan. I'd rather be the lender and take it back.
Last December, a Chinese publicly traded company bought a site in Williamsburg and to build condominiums. And part of it is they're going to be selling the condominiums to people in China. You know, so investors are truly coming up from around the world. But I'm getting back to my question to you about inexperience. I'm not talking about M&T. I'm not worried about you.
No, I think
I'm talking about other banks who, you know, who are coming here and they're saying, you know what, this is a world of opportunity. And if I'm in the banking business, I got to be in the Big Apple.
I think where you saw guys really carving up small units is primarily in really prime, like West Village locations and to some degree East Village locations. And there's a huge demand down there, and there's not a lot of inventory. So those models have worked pretty well these last few years. I mean, to the extent that the guys have been doing, you know, a few rental conversions and made a 2-bedroom out of 700 square feet, and now they want to do condos, we wouldn't finance the condos.
Well, just remember about plug on the real estate industry, there's always a value. It may not be the value you want it to be, but there's always a value. I can paint and wallpaper my wall with the stock certificates of the companies that have zero value versus the real estate that might be remaining and still there. So it's never at zero value. So you know if you want to talk about core,
having taken back a building that was costing me $1 million a month at one point. Sometimes it feels like there's zero value.
negative value.
Yeah,
but you know,
but now you own it, right?
We actually got all of our money back.
There you go. There's my point.
But wait a second. What about
my
this
case.
Pollyanna over here or my rose-colored glasses? You know, let's talk. You know, I brought up the fact that the office market isn't doing that well in Manhattan.
Not in Midtown for sure. I mean, and I think it has to do with the financial services layoffs.
And also fundamentals again. Companies are thinking about space needs. Yeah. They don't. Do we need the usual average that I grew up in for the 30, 40 years I was in the business? The typical statement was 100 square feet per person. Now, is that realistic today with hoteling, with the people walking around with their iPads, their iPhones? You don't need 100 square feet.
Well,
but you still have your abacus, I think.
I still have my abacus.
No,
yes.
but that's like more like a trading floor. I mean, we just renewed our space. And to give you a sense of what's happening for a corporate user, we went from $275 a user, and that includes boardrooms, et cetera, to $225 a user in same space.
So you're talking about a 15% cut, 15 to 18%
exactly.
cut.
Mm-hmm.
Well, some of the most interesting gains in wealth have occurred in properties south of 42nd Street, in the Midtown South and other areas of which they're dreaming up new names. And a lot of these owners, you know, had buildings that were never worth more than $200 a foot. Now they're trading at $600 a foot. A lot of them are owned in syndications that were put together 35 years ago.
Let's be realistic. Look at the Malkin. The Malkin portfolio, the Empire State portfolio, was put together 55, 60 years ago, predominantly with people who were from the Garment Center because that's where their people were. And all these buildings are now going into a REIT, and these properties have increased in value. I mean, substantial. I mean, Times Square, you know, the Harbor Group was advertised, bought a building 2 years ago. They paid $150 million. Now it's up for sale for $260 million.
Look at the St. Regis retail. They bought it for $130 million and sold it for $320 million in 2.5 years.
But retail is doing well because of tourism. I mean, I can talk about the positive.
New York City's doing well because of tourism.
I mean, when you have 52 million visitors to New York City, and this constantly needs, and that's why hotels are over there. And
if they're coming from Europe, they have a 30% discount that they come into this country with their currency versus ours.
You have to remember, the euro goes up and down. It's not always 30%.
Well, it's not, but give or take a few dollars.
If you were walking around Easter week, it was absolutely packed. It felt like 2006 again, didn't it?
It was absolutely packed.
I mean, you have a hotel in Times Square?
We own a hotel at 48th and Broadway, the Crown Plaza. We're running 95, 96% on a year-round basis.
Occupancy.
Occupancy on a year-round basis, and that's in a time period, the last 3 years, that there's actually been record increases in supply. 3% of stock has been added from all the new deals being built. It's not all, in Times Square,
Great story.
but a lot of it is built in some of these limited service,
You
and
know,
those limited service hotels,
the most
they've been very
successful area
successful.
today of new hotels is Times Square West, which
Right.
is like
39th
8th
Street.
and 9th.
From 39th Street.
39th Street. No,
Oh,
39th Street.
oh.
Between 8th and 9th Avenue, you have 6 hotels. You have all the situation. M&T has done it, but when they've been doing loans, they've been doing it as a business. They haven't been doing it as a real estate. They're looking at it truly as a business loan. So, do you see, for the optimists, where's the potential? Where do you think the next good location in this region is?
I think the West Side has continued expansion. I think that it's only just begun. We own the block front from 38th to 39th and 10th Avenue. When we bought that only 6 years ago, there were parking lots all around us. It's now thousands of residential units. We have a building going up right next to us, 200,000-foot residential building on a relatively small, inefficient plot. And the vacancy rates are very low.
Okay, there is 8.5 million square feet of space planned for Hudson Yards and neighboring area. The properties over there because of the train and everything else. They got the redistricting. There is no question. I mean, the Javits Center, there's a question of what happens. I mean, there's a lot of opportunities, but certain parts of the city have not seen this opportunities. Queens has not done that well for new apartments going over there. But Brooklyn is booming, every section of Brooklyn. What about New Jersey? You're a Jersey resident, Mr.
Oh,
Ortiz.
well, New Jersey, from a commercial standpoint, their office spaces, they're generally, they're flat, and they're going to continue to probably be flat on the commercial side. On residential side, no question New Jersey's been impacted. Remember, New Jersey lost 1 congressional seat, which is people leaving the state, not coming in. And this was the country's most densely populated state. So that's an indicator that New Jersey has a very burdensome tax structure. And that tax structure does chase people away.
New York doesn't have that.
Well, New York,
tax structure.
but let me give an example. I have a very nice home in Princeton. I live in Princeton, and the value of a home in Princeton, what I pay in real estate taxes, is 1/3 of what somebody that has a condominium apartment with the same value, a lot less square feet, but they're paying 1/3 of the taxes I'm paying on my real estate. So obviously, if you're sitting where I'm sitting, New York City real estate is a bargain from a real estate tax standpoint. And I would say it's probably the difference in terms of the spread between what I pay on income tax and what would be the New York City is closing. So the question becomes, do I come back to New York City and say, this is where I'm going to be? Because I always love the city, and I'm still a city guy in my heart. I'm a kid from Queens. Bottom line, I'd say what the real issue is, the recession for New York is over.
Okay.
The,
And we're over.
and, oh, we're over?
We're over too.
But it is. That's
Okay.
New York City, the recession's over.
Great. And I'd like to thank my friends Gino Martocci, Tom Lydon, Mitch Rutter, and Jim Orfanides, and I'll see you next week.